Hey there, everyone. Happy Tuesday, and welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from a quite rainy Olympic Peninsula, Washington. Great to be with you. Thanks for flexibility. We're doing this a couple hours after we normally do it here at 4 p.m. Pacific time, but it did allow us to get in a very wet and rainy hike along the coast, looking at Canada across the hazy, rainy view, but still an enjoyable one. We're having a blast out here. It's spring break. My daughter is out of town on a class trip. It is my wife and my son and I, and my dog enjoying a break from being at home. Still happy to bring the show to you. I just appreciate the flexibility of allowing me to do it when I can get to it between hikes and dinners and fun and all that sort of stuff. Hope you guys are all doing well and hanging in there wherever you're at. I mean, quite a period in market history, to be honest with you, and certainly I don't know what's going to happen next, but I do know we will look back to this period as a huge learning experience about what's possible in the financial markets, given a huge amount of dislocation. We often talk about market changes and market regimes as changes of character, right? But this is beyond that. This is almost a change of entire personality, a change of everything. The game has changed in arguably some irreversible ways, I would say, with what we're seeing. Today, we're going to talk about these market conditions today on Tuesday after a very volatile session on Monday coming out of the weekend. Today opened quite strong, and certainly the market opened with optimism that we could maybe be resolving some of these tariff discussions before many of them get implemented as early as this evening. Through the course of the day, it became very clear that that was not in the cards and that the administration is standing by these tariffs, which means the market once again downgrading an outlook for the U.S. markets, indeed the global markets, and certainly the U.S. economy. General averages moving lower. All 11 of the S&P sectors moving lower. The breadth has gone from quite bad to exceptionally bad. And again, bounces like this in the morning, kind of a reminder we've talked about, is this a buy the dips or sell the rips kind of environment? I have described this as a sell the rips environment. I think today is a perfect little mini version of why that's kind of how you want to do it. When quick jumps higher are sold, when people are just so excited to get out in a little bit of an uptick, that tells you about the general investor psychology, the sentiment that's out there, the fear that is rampant for arguably very good reasons, because undoubtedly, if a lot of these tariffs actually do materialize and are implemented, and even if it just takes a while to resolve them, U.S. companies, certainly global companies, are left trying to navigate this and trying to, in some ways, deal with much higher costs, costs of supplies, costs of imports and exports, costs that are most likely passed on to the consumer. That means sentiment gets pretty bad. That means the economy is not in a position to grow under that environment. That's arguably a easy way to make the economy not grow, would be do those kinds of things. So there's my brief commentary on the logic of the tariffs that I'm unwinding. To keep it technical and keep it focused, let's get to the market recap and see how things played out. And again, it was sort of in a brief optimistic moment out of the open that was basically beaten down through the course of the day. End of the day, you can see the S&P 500 closing down 1.6%. The NASDAQ composite finishing down 2.2%. The Dow, the best of these three, still down 0.8% for the day. Mid caps and small caps feeling the pain as well. The S&P 600 small cap index down 3%. It just shows you that there's no area of the market necessarily that is immune from all these forces that we've talked about. And I think this is one of the challenges of a truly globalized economy. Everything, even a small U.S. company, is interacting with products and services outside the U.S. And so these tariffs are kind of touching everyone, I feel like, in a lot of different ways, and certainly touching the consumers here in the U.S. The VIX pushing another 5 points higher to just over 52. I have a long-term chart of the VIX just to show you how incredibly rare it is for the VIX to get up at these levels. And it is very rarely in any kind of good position when it does so. This is one of those rampant fear kind of markets when I've learned being on the sidelines is a very happy place to be, and just watching to see how things all play out. The bond markets pushed lower today. You can see the TLT down 1.9%, pushing interest rates higher. The 10-year yield is up around 4.25. The long bond yield just above 4.7%. The 5-year point getting closer to back to 4%, just above 3.9%. Now, what's happening here, because it seems a little bit counterintuitive that you think, all right, if investors are worried, they probably go to a safe haven like bonds. Shouldn't bond prices be going up? And that is the general playbook in this kind of environment. There's a treasury auction earlier today, and it was a very dismal outcome. Not a lot of demand for U.S. Treasury, which implies, as we've talked about with the weakness in the dollar, it just implies that there's not a ton of assets floating into U.S. dollars buying U.S. Treasuries in this environment. They're going somewhere else. And as a result, bond prices lower, bond yields higher. The dollar index down slightly, about 0.5% lower for the UUP today. Looking at the commodity space, hey, a brief bright spot I can share with you. Gold prices did not go down. They actually opened higher along with stocks. And while stocks ended up being negative for the day, the GLD actually held up a little bit. The GLD closed around 275, and that's up about 0.5%. That's not a great day, but compared to a lot of other things that were down quite a bit, it certainly feels pretty good. We can see crude oil prices, natural gas prices, copper prices all down around 4% today. And so the energy area of the commodity space certainly feeling some pain. Cryptocurrencies, which had held up a bit last week, right? Going into the weekend, it was sort of a weird environment where Bitcoin was holding steady while equity indexes were rolling over going into the weekend. This week, we're getting back to cryptocurrencies rolling off along with other risk assets. Today in particular, you can see Bitcoin down about 3.4%. That's currently around 76,500. Ether prices back below 1,500 now. That's down almost 6% today. Most of the top 10 coins on the stock charts platform all in the red. Looking at the 11 S&P sectors. Now, earlier in the day, this looked a lot more encouraging. It sort of felt like maybe yesterday's bounce continuing with sort of a growth-led, renewed optimism. Maybe this is a short-term thing kind of environment. Not the case. Financials, your top performer, which is interesting because big banks are start reporting earnings on Friday. You've got Goldman Sachs. I think Goldman's on Monday, but JP Morgan I know is on Friday, and some others as well. So that'll be our first tastes of this next earnings season and what sort of discussion we hear CEOs and CFOs bringing to the table in terms of how these this new world of tariffs, just how they're trying to navigate that and what sort of impacts they're seeing. I would expect another big catalyst for movement in stocks based on that. I would not be surprised if that sort of initiates another leg lower, because I can't imagine it's going to be optimism from these company management teams just trying to digest the realities and make expectations clear. Having said that, financials the best performer, down about 0.4%. Utilities about the same. Industrials down 0.8%. On the downside, materials down 3.1%. Real estate down 2.5%. Consumer discretionary, the XLY, down 2.4%. So staples were down about 1.6%. Discretionary down 2.4%. So we're kind of continuing that trend of defense outperforming offense, generally speaking, with U.S. equities. The breadth, not great. I think that no real change from the negative breadth we've been talking about really since last Wednesday. Once these tariffs were announced, the breadth has really accelerated to the downside. Today, another 90% down day for the mid cap index, the small cap index, the S&P large cap 500 index, about 86% down. So almost another 90% day. So these are broad declines with very few things finding a bid, pretty much everything rolling over. And again, earlier in the day, the breadth was less negative, but through the course of the day, you just see this wave of selling. And that's probably the most discouraging takeaway I would have from this particular day. Two things. Number one, a treasury auction that did not go particularly well. That's not great because that would at least imply some sort of safe haven in U.S. Treasury debt. That's not the vibe I got. It was more of a no appetite type of vibe. And then with breadth, you're getting, initial gaps higher, initial rallies met with a ton of selling. And that's really what a bear market feels like. It kind of like this. So really just reinforcing the negative trends that we've been talking about. Speaking of rare bright spots, Broadcom actually up 1.25%. The chart's still not great. So to be clear, from a technical perspective, all of these charts I would say are questionable at best. But Broadcom actually finishing 1.25% higher, maybe something to watch there. Netflix up about 1/3%. The rest of these names were down. Apple and Tesla, which have really been taking it on the chin more than most in the Magnificent Seven. Obviously, a lot of ties with overseas markets. etc. So Apple and Tesla both down about 5% of the day. I did grab both of those charts separately so we could review them together here in the chart review portion of the day. All right, I do see some questions coming in. Again, thanks for being flexible today and this week, giving me the freedom to go live with the show a little bit later than normal. It's helping me have some time with my family here out on the hiking trails, having good meals and good time together, and that means a ton. So I appreciate it. But we are live streaming on Facebook, LinkedIn, YouTube, and X. I appreciate you guys joining me live. Those that are, you can ask questions all during the broadcast. At the end, we'll take a question or two before we wrap for the evening. And please drop a question in there as they come up. I'll take one or two here at the end of the show. All right, looking at the heat map here, I mean, obviously pretty negative, right? And we know this is a negative day. We know the breadth was overwhelmingly negative. So let's focus on where we saw the most negative moves, just to sort of get a sense of what's driving things downwards. You can see in technology, there actually were some random stocks that finished positive. So I mentioned Broadcom, but again, that's bouncing off of a new 3-month low yesterday. So I would not say that's a great chart. Arista Network, same thing, undercut $70 going into today's session. So these are counter trend bounces within clear downtrends, I would argue. Western Digital, again, a brief bounce after a downtrend. So even the charts that are up, I mean, these are not good charts by any definition, I would say. These are, clear downtrends. And if anything, you're just getting brief bounces off the low. By the way, I don't know if you noticed, but the symbol that was on my screen as I went live was TQQQ. There was a huge bet today, one of the biggest flows into the TQQ like in history. TQQQ, the triple leveraged long QQQ ETF. So someone making an aggressive bet on a rally in technology. Not a bet I would be making personally at any point in my portfolio, but definitely on a day like today. I can only assume that's someone betting that these stocks have been beaten down a ton and that you get a counter trend move. I mean, as a trade, I get the logic of it. Is that something I would want to do? I would not, but that's something that happened today. For what it's worth, maybe a huge bounce tomorrow is coming. Who knows? But not what I'm seeing in the on the charts. So most of technology, obviously not particularly strong. You can see a lot of sort of clusters of negative movements in consumer discretionary, certainly in healthcare, in industrials, and then the defensive sectors, particularly energy, REITs, materials, consumer staples. I mean, just a lot of stocks down quite a bit. Things where you actually saw less deterioration, or at least some signs of optimism, right? When there's a day that's down so much, look for things that are actually in the positive. Interestingly enough, in financials, and I think that's a key theme to pay attention to going into the end of this week. Friday's when earnings season kicks off. It's a bunch of financial companies on Friday, and then Monday, then it sort of builds out into other sectors in the days and weeks after that. But this is where we're going to get our first taste of what this earnings season is going to be about. Interesting that JP Morgan's up 1% today. Progressive, which has been one of the better charts, but obviously pulled back with most other things. Some of the exchanges, data providers, CME, SPGIs, S&P Global, these are stocks that are actually bouncing today. So there are some things bouncing. Again, I would say the charts are not great in any of those at the moment. They're either in downtrends or pulling back and really not showing enough of a recovery. I did grab either JP Morgan or Goldman Sachs. I forget which one I grabbed to review here. I think I did. I was grabbing a lot of charts here before we went live. Another thing I would note is defense stocks. So RTX, Raytheon, LMT is Lockheed Martin, General Dynamics, Northrop Grumman. Again, I mean, from a technical perspective, I mean, I just don't see these as great charts. I mean, they're not going down as much as others, and that's encouraging. The relative strength is improving. That's encouraging. We're finding support, right? So Lockheed Martin made a low in mid-February around 420 and sort of continuing to hold that level. So, I mean, this is an okay chart. Is it a great chart? It is not, right? We're still below the 200-day. We're still making lower highs. The momentum is still in the negative range. So, maybe you look for charts like this as potential reversals. And certainly if you have to own equities, owning names where the relative strength is improving is a really good way to weather this kind of period. So again, not a great chart yet. I mean, these are, less bad than some of the other charts I could show you, but still not great. Also, random things within healthcare, right? Now, United Healthcare up over 5%. arguably a decent chart, making a new 3-month high today. I did grab that one. We'll look at that together here in a moment. So random things, but it's not many. If you run a scan for stocks making new 3-month highs this week, there's not going to be much on that list, but those are certainly things I would be looking at because they're things not going down when most things are managing to do so. All right, looking at the chart, here's what the S&P has done. I'm keeping a clock here on the low from yesterday because for now, that's the low for the cycle. That's about a 20% haircut from where we were in mid-February to now where we are at in the second week, second week in April. That was the intraday low yesterday. Here's today, opening toward the upper end of yesterday's range, closing down toward the lower half of today's range. The RSI nearing 20, so we're in almost an extreme oversold condition. This is a market going down. It's not the kind of market I would be buying personally until we find some sort of stability, right? Some signs of accumulation, but not certainly not seeing that yet. We updated, I think yesterday and certainly last week, some of our downside targets that we have in mind. 4,800 is an interesting level when you look at the long-term Fibonacci retracements. I didn't bring the weekly chart of the S&P, so let me just bring that up real quick because I wanted to remember what that level, the 150-week moving average, right around 47.50, 47.60. So that's an important level to watch. A lot of times you'll find the market either hold support there, it doesn't get much lower than that. So that's when you start to think, okay, now we're nearing a point where I might want to start accumulating if I have a long enough runway. But again, that's using a pretty classic correction playbook. I don't know if a classic playbook necessarily works in this environment because we're just going down a ton. The weekly chart of the S&P, by the way, a really good thing to watch because, in this sort of environment, if you look at major corrections back in history, weekly PPO indicator giving a buy signal usually happens after the low. But if you just patiently wait for that, and you can be a little more aggressive before then, but just waiting to confirm before you'd really go all in. That's kind of how I approach this sort of market. I'm happy being out of the way. I'm happy being very defensive at the moment and waiting for sort of that sign of optimism. That is not a word I would use to describe any technical evidence I'm observing right about now, I'll be honest with you. Let's look at a couple breadth indicators, and then I have a chart called the chart, which I think is a really important one to keep handy because it's a great sort of checklist of some of the main breadth indicators I think are important to follow here. Here's the daily chart of the S&P 500. Again, we're closing around 49.83 today. So we're back below 5,000 for the first time since April of 2024. So it's been about a year since we've been down at these levels. But here we are. You can see that stocks above their 200-day, we're down below 20%. This is the lowest we've been probably since 2002. I don't have that on the chart here visually, but it's off the left side of the chart, I would imagine, back then. Percent of stocks above their 50-day, we're down to 6%, right? So almost the entire S&P 500 is currently below its 50-day moving average. So this is obviously a very broad decline. Everything's kind of going down. You can think of that as a contrarian signal and looking for a buy signal. I would not think of it that way in this environment, only because in protracted declines, you will find indicators like this get very negative and stay very negative. So indicators like this in more of a bullish phase, looking for those pullbacks to beaten down levels, can be great buying opportunities as like a buy on the dips to go higher. This might indicate a brief bounce, but it's not telling you, we're at a bottom. I think there's a different checklist I will probably have to clean off here in the near future and start talking about, but I'm not ready for that. All right, the S&P 500 bullish percent index, not quite to 10%, but at the lowest levels we've seen since the September 22 reading. That was just before the eventual low about a month later in October. So breadth indicators getting very bombed out here. And again, pretty common to see that in bear market environments. And again, I mean, if you look like at June 2022, we get down to these same levels. We have a bounce, but then we end up making a new low. And that's why, again, in a real negative market, you'll find these counter trend bounces, but it's more of a sell the rips kind of environment as we continue to go lower. I would say by my read, that's where we're at right now. I wanted to show you the cumulative advanced decline lines because the broad New York Stock Exchange, which is the main one we watch, did break down over the last week. That's pretty negative. The mid cap and small cap AD lines have already made new lows. That's bearish. The only one that is not is the S&P 500. About a week ago, it was actually looking fairly strong, almost making a new 52-week high, if you can believe that. What a difference a week makes, because now we're heading back toward the lower end. And I would say the S&P's advanced decline line breaking to a new low for 2025 arguably could be the signal of another big wave lower, would be my general guess there. So a lot of those things that we just looked at, I have one chart, which I just called the chart. And this really started as a joke years ago, when someone on the desk I was on would ask me, what does the chart say about the markets? And I would jokingly just have one chart with a bunch of stuff. And I'd say, yeah, here's the chart. And we just, and I realized it was kind of helpful to have a bunch of things on one list, sort of like a checklist, and just look top to bottom. So this is on my market misbehavior live chart list. If you go to marketmisbehavior.com/charts, you'll get to a live version on stock charts, which you can access whether or not you're a stock charts member, with these charts, this and many other charts that I keep updated, randomly during the week. If you are a stock charts member, you can save them to your own account, of course, and do whatever you like with them. But this is one that is on that main chart list and has been for years. And going from top to bottom, the S&P is making lower highs and lower lows. That's bearish. The advanced decline line on the New York Stock Exchange has made a new 3-month low. That's bearish. We are now down to 6% of stocks above their 50-day moving average. If you look at forward returns in that environment, certainly if you look out long enough, it's probably positive. I mean, I would guess the average 12-month returns after this indicator is so low is probably pretty good, which means, and again, think about what that means. If you want to close your eyes and plug your nose and buy a bunch of things now and just ignore what happens in the markets over the next 12 months, are we going to be higher 12 months from now? I would guess probably. I think that's fair. But how we get from point A today to point B 12 months from now could be a very challenging period. And I don't know if I want to just close my eyes and ignore that. I would much rather be defensive and not participate in the downside, and then get more aggressive when I see signs of a rotation higher and participate in that gain back to that elevated level. That's a much more the way that I've learned to. That's what the trend following mentality is, as opposed to just a buy and hold mentality. So for me, I get the idea and the argument for those long-term sort of outlook studies, but it doesn't tell you that a month or two from now, we can't be a ton lower, at which point you're probably going to be happy not owning stocks. And that's kind of why I'm happy being defensive here. Bullish percent index, by the way, down to 12%, very, very low. And again, with this is one of those where, as an example, breaking back above 30%, only then would I look at that indicator and say, okay, maybe this is a time I want to make a little, a trade for a push higher, but we're obviously well below those levels. And now defense has been outperforming offense pretty clearly since mid-February. Talk about a change over the last couple of years up until mid-February 2025 to what we've seen afterwards, with defense certainly outperforming offense. Chaikin money flow, as you could probably guess, pretty negative here. And you can see that the volume on the SPY has been aggressively high over the last couple of days. All those bars are red because they've been down closes. The volume is the heaviest we've seen in years. The Chaikin money flow, as a result, really starting to tilt negative. That's another one of those. This is one of those indicators. It's often pretty good at identifying some buyable rallies. Certainly after we've had a bottom, if you're waiting for confirmation, this is one of those charts I would use to confirm, because you'll see after a low, the price starts to turn higher, and eventually the volume on those up days is enough to turn the indicator back bullish. And that's sort of an all clear sign that tells you, okay, we're really starting to accumulate or see appreciation. Not yet. I mentioned the Treasury, sale that did not go particularly well today. Rates now popping higher this week. The $TNX, which is the 10-year Treasury yield, really close to breaking above trendline resistance. If you look at the high from January, the high from February, lines up pretty well with the high from late March. That's above current levels. The 50-day moving average is right around 435 as well. So we're pretty close to where the 10-year Treasury yield would be breaking out. That would actually coincide with bond prices breaking down. So that's something to watch for as well. This one chart just looks at some currencies and commodities. We have the dollar index here at the top, crude oil, gold. Let's go 1, 2, 3 very quickly. So we're seeing a bit of a bounce here in the dollar, but just as a reminder, with how much stocks have sold off from mid-February to mid-April, it is highly unusual, if you look at market history, for the dollar to be down so much during that period. Usually when investors globally are getting nervous, they start piling into US dollars and US treasuries and things like that, which are seen as safe havens. We're not seeing that. And I think that for me is one of those big red flags. We talked about this, I think, on the show yesterday, that, you wonder how much of the bull phase that we experienced into February of 2025 was driven in no small part by non-US investors investing in US markets because they were so strong, because technology and growth was leading. It's an AI-driven frenzy of upside and a risk-on environment driven by the biggest financial market in the world. You're not seeing investors flock to the relative safety of the US dollar here. Their assets are staying somewhere else. And my concern is that those assets don't come back in as meaningful way as we've seen. And if one of the ugly side effects of this whole tariff thing, however it ends, hopefully at some point and feels more constructive here, but if one of the bad side effects is that those non-US investments don't come back in the way that they had, I think that next bull phase is a lot less powerful, because that was certainly, I mean, look at any measure of non-US investment in the US markets, remarkably high going into 2025. And I think that this may be part of the negative side effects of what we're experiencing here. Crude oil prices coming down quite a bit from the moment tariffs were announced. Crude oil prices starting to come down. That's not great for energy stocks. I saw someone asked about energy. We'll get to that if we have time. But energy stocks are driven by the price of crude oil. We're below $60 a barrel for the first time in quite some time. Gold prices are pulling back this week, but again, nowhere near the pullback that we've seen in crude oil. Certainly nowhere near the pullback we've seen in stocks. You can see just year to date, stocks going lower, crude oil basically going lower, and it's sort of bouncing in late March, but now resuming that downtrend, while gold arguably remains in an uptrend of higher highs and higher lows. So still own GLD and accounts that I manage, and IAU as well, both plays on physical gold. All right, looking at Bitcoin, I mean, Bitcoin is it's still not a good chart. I think you could make a technical argument for nearing a key support level around 73, 74,000. That's a key Fibonacci level that also lines up really well with the March 24 high. So kind of what we call a level of polarity or a pivot point, which is a level that has served as both resistance and support. Maybe something there. From a trend perspective, though, we're making lower highs. We're making another lower low this week. We're below both the 50 and 200-day moving average. This is the kind of chart when it does this, I'm just happy waiting for Bitcoin to get back above 50, the RSI that is, because what that would mean is at least there's some improvement in momentum. At this point, we're making lower highs and lower lows. The RSI has been below 50 since the end of January. So that tells you really it's in a distribution phase, and I don't see that necessarily changing. I do still own Bitcoin personally, but I would say from a technical perspective, that chart is guilty until proven innocent, and I don't see signs of improvement yet. We did talk about this candle chart yesterday on the show, NVIDIA. This is called a bullish piercing line, where you're in a downtrend. You have a down candle, a solid candle. You have a lower open, and then a close that's at least 50% of the way back up through that first day's candle. It tells you the next 1 to 3 bars most likely higher. Today, we did make a higher high, but in a concerning fashion through the course of the day, just like the S&P. NVIDIA ended up actually finishing slightly lower, and it actually did sell off through the course of the trading day. Overall, I would say the trend in NVIDIA is still down. I don't think the candle pattern yesterday changed that. And this 2-bar pattern does have a natural built-in stops around 87. That would be the low of yesterday's candle. Overall, I would say NVIDIA is still in a downtrend. And that brief shining moment we talked about on yesterday's show, holding for now. Tesla also holding support. Also almost looked like support was going to break going into the close. This is the level we talked about yesterday, 220. That's the low from early March and mid-March. Also, the lows from this week right around that level. We'll see if that's holding through the course of this week. My gut would be no, given the distribution we're seeing elsewhere. This is the kind of chart, I think, breaking above 290, breaking back above the 200-day moving average would be a very bullish development. I don't see the signs of that happening just yet. A double bottom here. If we bounce going through the remainder of this week, maybe that's a really interesting opportunity to ride a bounce higher. But for now, I'm not seeing that improvement. All right, Apple. I just wanted to bring up the weekly chart of Apple just to show you how significant that is, because as much as we've sold off, and even going into Thursday's first sell-off related to tariffs, I'm still getting people talking about and thinking of this market as still a bullish market, and thinking you're crazy for not wanting to buy dips. I just want to reinforce how a chart like Apple is really starting to look quite different. Now it's almost holding, but we'll see. This is the weekly chart of Apple going back 15 years. And I'm looking at the 40 week, which is kind of similar to the 200-day in red, and then the 150-week moving average in purple. Look at how many times that this stock has held its 150-week moving average. Most recently, at the end of the 2022 decline, the pullback into the second quarter low in 2024, and we've actually undercut that moving average this week. Now, it has briefly gone below, like in 2016 and 2013. This is all using adjusted price data on the weekly chart going back for many, many years. However, I mean, this is right at that level that has held for quite a long time. And if the 150 weeks not going to hold, I mean, that's one of those signals that this is indeed a very different environment. And it certainly feels like a different environment we've experienced than we've been experiencing in years. And just the severity of the move, the complete deterioration in breadth and momentum that we've been looking at. Now, on a daily basis, I would say we are nearing a key support level. October 23, April 24 is right around $165 a share. That's not too far below current levels. We are oversold as we reach that level. Most recently, when we were here in March, April of 2024, we had this beautiful bullish momentum divergence. That, in my opinion, is like the ultimate outcome here. A period of deterioration, we make lower lows, and eventually we start to see improvement in momentum on those new lows. That would be a very encouraging sign. We're not seeing that yet. We're still seeing like impulse momentum telling you that the primary trend is down until further notice on the daily chart of Apple. Goldman kind of nearing a key support level as well. This is a 61.8% retracement of the 2023 low to the February 2025 high. We bounced off of 440 yesterday. This level's around 430, 428. So we're very close to that level where, again, Fibonacci retracements telling us maybe this is where we find support. We're oversold as we reach those levels. Goldman's actually reporting earnings not this week, I think on Monday of next week, but certainly part of that initial group of financial stocks reporting earnings. Certainly something to watch. Again, I see this as a pattern of lower highs and lower lows. So buying around this level is more of a contrarian play. It's more of a falling knife kind of approach where you're buying weakness. That's not how I usually trade. I much rather wait for signs of accumulation, wait for buy signals, not seeing them yet. The weekly chart of something like Goldman Sachs can be interesting for that as well. Is anything not going down? The good news is, yeah. And we've talked about a couple random names. It's not much, right, on the equity space. I mean, the general charts go from really bad to kind of bad, and okay is really good on a relative basis. I'm highlighting United Healthcare, but it ended up closing up over 5%. Earlier in the day, the stock was trading above 580, up to around 585 on an intraday basis. By the close, we got all the way down to 550. So we shed about 30 points from the intraday high to where we eventually, hit a low. So while it's up 5%, the sentiment during the day really suggested that investors were selling that gap higher, not really buying it for an opportunity to ride it to the next uptrend. It was sort of a, thank God I can sell something that's up a bit today and take some profits here. But having said that, the fact that we're making higher highs and higher lows on the tactical time frame, the fact that the relative strength is improving, tells me that I'd probably be happy owning a name like this at a time when most things are going down. Again, in a bearish market environment, relative strength becomes super important, because if you still probably, even if you're really bearish, you probably still have some exposure to stocks. I mean, I would guess in my portfolio, it's probably still around 20 to 30% of a portfolio. I mean, I never really go to all cash or anything like that. I'm still in some things. I'm just very underweight, and that's kind of a natural way to be defensive. But what you do with that equity allocation, you can do something about it. And focusing on names where the relative strength is quite strong can be a great way to ride out a period of market uncertainty. This is the kind of name that'll come up if you scan for stocks making new 3-month relative highs. That's the kind of name I'd be looking for. All right, final chart, then I'll take a question here a bit. AMD, making a new low. And I just want to remind you again, when you think about the market here, if you find yourself, getting optimistic and thinking, all right, well, it's gotten really bad here. So at what point does this look bearish, or does this start to look bullish because it's down so much? You have to remember, charts like AMD have been going down for a while, right? AMD was actually making a new 52-week low in December of last year. And so far, year to date, it's just continued to get worse. There are AMDs of the world, semiconductor stocks, which in a bullish environment would hopefully be looking a lot better than this, are making lower lows and lower highs. This is making a new 52-week low today, and the weekly chart is even worse. And when I talk about looking for signs of accumulation, I mean, what you see in AMD over the last 12 months looks a lot like AMD from late 21 to late 22. It went down for about 12 months. Now, what told us that downtrend, that long-term downtrend in AMD was over? After we'd undercut the 200-day, after we'd undercut the 150-week moving average, which we also did earlier this year, we started to get buy signals from an indicator like PPO, right, which is one of those long-term lagging indicators trying to give us a buy signal only after we start to improve. So when something's down a lot like this, until and unless we start to get buy signals from indicators like this, it's telling you the primary trend is still down. And as of today, that's what I'm seeing on the chart of AMD and a lot of other growth names as well. All right, shall we take a question or two before we wrap up? Let's see. Random Q hacker. Dave, if this correction turns into a crash, do you still expect a flight to safety to TLT? I mean, it's such a tough question, and I appreciate the question so much. I mentioned this earlier, right? I mean, and this is something I think I mentioned on yesterday's show, talking to Gina Martin Adams of Bloomberg, and she presented at the CMT event in San Francisco over the weekend, and I got a chance to chat with her a bit. There's sort of the traditional correction playbook that you can think about. And in general, when investors get really nervous, you tend to see the dollar strengthening, and you usually see safe haven things like gold, like bonds, start to improve. We're not seeing that. And again, I think one of my concerns would be maybe we don't see that in a way we've seen in previous cycles. And it's the same thing. I can't, I'm not an economist. I'm not going to tell you that the dollar is no longer going to be the reserve currency, although I've read and spoken to smart people who talk about that sort of thing. But that's where that could be a problem, right? If the dollar sort of does not become, is no longer a reserve currency or has less of a reserve currency status that we've experienced for so long, maybe that traditional safe haven move to dollars just isn't the same, or is just different, or changes. And that's what concerns me. I feel like the normal correction playbook in some ways is kind of going away. And the reason is because this literally, I mean, I've been doing this 25 years almost. This is new territory in terms of a president coming in and doing these things that we're seeing, and making the aggressive changes to a global economic system of which so many companies and so many consumers and so many, national economies are built around. If that all changes, I don't know if that traditional playbook is going to be necessarily helpful. I would tell you that charts become really powerful because that's going to tell you where funds are flowing. And my interview last week, who was it with? Oh, shoot. It'll come to me after. I actually have my laptop right in front of me because I'm streaming this. It was with Mike Green. Yeah, we talked about this, about fund flows about a week ago. Go back and listen to that interview because we talked all about following flows. There are different ways to do that, but I think price is a great way of recognizing where funds are flowing to. And I think that could be a really good way of figuring out what the new playbook may look like, is to analyze the trends and analyze those flips and just see where the trends are rotating. But a lot of the traditional moves I would see at this point in the cycle of a correction, I'm not kind of seeing. And so I think that's a challenge. I wanted to grab this question. My name is Chuck. Thanks for watching on YouTube, my friend. And you said it looks like the VIX went to 79 in 2008. Any comment on that time? I remember that time for sure. But let's look at the chart here. All right, so we'll look at the VIX. I'm going to look at a weekly chart. We're going to go back, way back, like 25 years, just to kind of show this. And your comment was, yeah, the VIX has gotten this high before. What's there? Right. So here's what we do, right? We change this and we say price, and we'll say the S&P on a log scale, and we'll get rid of this. And that should be a pretty cool chart to look at. Right. And then we make this bigger so we can actually see what we're doing. There we go. All right. Here's a weekly chart of the VIX in the top panel. This is the period you're asking about, 2008. Yeah. I mean, there are very few times I mentioned on the chart of the VIX, very few observations. This is a 25-year chart. You can see how rare it is for the VIX to get over 50. The last time we did that was that real kind of random spike in the VIX in mid 2024. But the COVID crash was one of those. The great financial crisis in 2008, we got all the way up there. It took till late 2008 to actually get up to that point. What would that tell me? I mean, so yeah, my initial reaction is, yeah, we did get out to that point, which tells me two things. Number one, this feels like one of those rare pullbacks that do not happen often. Thankfully, they do not happen often, but when they do, they end up being pretty painful bear experiences. The good news is 2020, 2008, 2002, where the VIX didn't even get above 45, by the way, they ended up being great long-term buying opportunities eventually. But eventually, this is where the VIX spiked up to almost 90, by the way. That was here. And it was about another 3 months or so from, fourth quarter of 2008, where you got to that level, and the first quarter of 2009 in May or March, where we actually found the bottom. So what concerns me about the VIX being, at this point, is the VIX actually got here sort of about this point, right? So, I mean, if that's a you are here dot, I'm not feeling great about these markets for the next couple months. But again, if you look at where we're at, look 12 months down the road, the S&P was higher. And that's a lot of the statistics that I've seen that are spun as very bullish statistics, which arguably they are. If your runway is long enough and you can either ride out this period of market uncertainty and deterioration, or just buy and not pay attention to the markets for 12 months, you'll probably be happy 12 months from now. Now, would you be happier not participating in this downtrend and then getting back in and riding more of the uptrend higher? I would argue probably. And that's why we follow the trends. That's why we follow the charts. That's why we follow the sentiment as it deteriorates. And I promise, if you continue to watch the show, I will do my best to keep you up to date on how all of these charts are evolving. It is a fascinating period to be following the markets, fascinating period to be an investor, but a period of which I am very thankful that I have this show to navigate them with all of you. Listen, guys, thank you so much for watching. I see a number of people watching live, some really good questions. I did get to a couple. I didn't get to all of them. I'll put the ones we didn't get to in our mailbag. We'll do an all mailbag episode on Friday, which I hope you will check. Apologies for going a little late today, but I appreciate you guys being patient and flexible this week as I enjoy spring break with my family and still try to do a show to keep you updated as I can. Thanks so much. I appreciate you watching. And remember, it's always a good time to own good charts. Have a great night, folks.